Today, folks, we're diving into some news, some updates, some earnings reports coming out of the real estate investment trust giant that is Smart Centers. We're going to be talking about the good, the bad, the ugly, everything you're going to want to know about this current market environment and how it's affecting these billion-dollar REITs. Then at the end of this video, I'm going to share with you a few other REITs that I think are very resilient and are very stabilized for this market environment. So that's a conversation you'd appreciate. Hit that like button, because taking a look at Smart Centers stock here, this thing has not done any growth over pretty much its history for the last decade. Year to date, only up 1.57%, nothing comparable to the TSX or the S&P 500. Over the last year, even from the October lows, is only really trading up 9 to 10%. So we're not really buying this for any growth metrics. We're probably just buying it to get some dividends, some cash flow today, because it's paying a 6.73% yield. We'll talk about some of the safety in that yield and where it sits today, but taking a look at the dividend growth, this has been, nominal at best. There's nothing crazy going on here. 10 years ago paying a 13-cent monthly to today where it's paying 15 cents monthly. So we're not really buying this for dividend growth either. So it's better to buy it on the dips if it's a stock you're interested in, to lock in the highest yield possible, because again, we're not really seeing a whole lot of, gross profit growth here, total revenue growth. It's all been relatively flatlining, but this company I do believe has a future, and it'd be neat to see in this current market environment how that comes into play over the next 5 years. Because if you don't know Smart Centers, it's primarily a mall-based REIT, a retail REIT with encore tenants like Walmart, Loblaws, Shoppers Drug Mart, Canadian Tire, Lowe's, Dollarama, RBC, really good stabilized clients. And like REIT, it's primarily fixated in Ontario, Toronto, so it does have a bit of a monopoly because there's not new malls going up, and they are taking advantage of those malls in ways that is really hard to wrap your head around. Their development pipeline is extremely extensive. Being a mall REIT, they have a lot of property to work with, and like REIT, they're taking advantage of that by basically building condos, just building residential areas surrounding these malls. And I could scroll through this for days. I mean, to try and wrap your head around just one of these projects is kind of unimaginable because they're so damn large. But look at this. I'm just going to keep scrolling. You can see every one of these development projects are just so damn. Look at this one. Look at how many buildings they have here that they're looking to take advantage of in these areas. And again, it goes on and on and on and on and on and on and on. So I highly recommend that you take some time, if you're interested in this REIT, to go check it out. But let's kind of get into some of the numbers here, guys, because on the last earnings report, the shopping center leasing activity remains strong with industry-leading occupancy levels of 98%. Again, malls, people thought they were dead. Clearly they weren't, as Q4 2022 representing a 40 basis point increase. Same property NOI for the quarter increased 5.1 million or 4%. But from the financial standpoint, the funds from operation with adjustment, including the impact of TRS for the quarter, increased 1 million or 1.1% compared to Q4 of 2021. And for the full year, increased 9.6 million or 2.7%. So again, we're not talking about any kind of explosive growth yet. That really has to come into play with the development. The payout ratio really good here at 92.6% as a result of fair value adjustments to property valuations, because we've seen these properties correcting pretty heavily. Condo and townhouse closing that occurred in 2021, net income and comprehensive income for the quarter decreased by 551 million or 84.6% as compared to Q4 of 2021. So they are being impacted on some varying degrees, but again, they're probably taking advantage of write-downs. With a total net base rent is something that I always tell you to fixate on the most. Is the rent continuing to go up? And over 2021, that is proving to be true. 494 million to 508 million, which is pretty damn impressive. It's nice to see that stabilize, because that's what we're relying on to get the dividends, which we can see the dividends declared here at 329 million. They do have a bit of a surplus by the looks of it, about 10 million. So just from the adjustments here over the distributions declared. So they do got a little bit of extra cash sitting aside, and they're seeming to be stabilized. But some of the things you really want to pay attention to here is the insane amount of mixed use development. I mean, the properties here sit at 274. They currently have a total number of properties in ownership of 185, slight increase over 2021. So taking a look at the total assets sitting at 11.7 billion, a slight increase from about 11.3 billion in 2021. Taking a look at the debt non-GAAP sitting at about 5.2 billion. So they're sitting just under that kind of 50% ratio. Debt to aggregate assets is about 43%, which is pretty good all in all. I mean, this is still a bit of a higher level, and it can be quite a bit of a concern when, again, you're seeing that average weighted interest rate go up. So when you take a look at the interest rate here, guys, it's sitting at 3.86%. And outside of the interest rate going up, we want to pay attention to when the leases, the mortgages come due, because that's where we're really going to see the impact of cash flow on the higher interest rate environment. And luckily, they've got about a 4-year spread before, the average weighted term on their debts is 4 years. So they do got time to let this interest rate cushion itself out, but it still affects them on any new builds, new mortgages, all that stuff. And we are seeing that average year kind of drop down over last year from 4.8 to 4. So there is some cushion. I think they'll be able to ride through this fine. But again, this is the stuff that you got to pay a lot of attention to. And the only thing that I don't like about smart centers is for the lack of growth that you're getting. They're still diluting us as shareholders. Over 2021, we can see the average diluted shares continuing to go up, but we're not really seeing much of an increase. A little bit of increase in assets, which is good, but total revenue isn't really changing that much for the amount of dilution we're starting to see here. And unlike some of the other REITs we're going to look at, that's probably some of the most concerning stuff with smart centers, but I still think they'll do just fine if you're just looking for that cash flow in this environment. I don't think they're going to go under. I don't think they're going to cut the dividend. I think they're in a good place for this environment, but I think REITs is in a better place just because I think they're starting to buy shares back. You take a look at REITs stock from the October lows, because there's no real dilution, because the company cut their dividend, because they stabilized the balance sheet. The stock has a little bit more volatility, leading to a bit better growth. It's up 25% since the October lows. It's up almost 7%, year to date. Kind of falling better in line with the market growth, but you're only getting a 4.52% yield, so not nearly the same as smart centers. But REIT, being a similar retail focused REIT with a lot of development in a very similar fashion to smart centers, again, we don't see any real growth. So these are stocks we're purely buying primarily just for dividends and income. So it's always recommended that, we were buying REIT on the pandemic lows. It was really good buying in the October lows. Try and pick this up on a dip when you're getting closer to that 5% yield. But REITs that are really resilient here in Canada, we'll take a look at a variety of them. I mean, Granite Real Estate Investment Trust still sticks out to me as an outlier. The yield 3.84%. The max history of the stock over the last since 2013, the 10-year history up 113, 114%. Really nice to see. Year to date, outpacing the S&P 500, up 19% from the lows, and is smashing the October lows. Really nice to see in a REIT like this, being primarily focused on logistics, warehousing. We can see the dividend increases, again, very nominal, nothing crazy. We're at about 0.26 cents monthly, which is nice from the 18 cents it was paying back in 2013. Some better increases over, say, smart centers. But again, these are things we want to catch on those dips if we're just looking for the dividends. But this one also offering growth. We can kind of see that even through 2022, waiting for the earnings to come out, but it should expect to see higher revenue and gross profit increases. So I do like seeing those metrics, dividend increases plus stock appreciation. I think that's the best of both worlds, but you're either going to sacrifice the dividend or you're going to sacrifice the growth. So it's always recommended to try and find a balance of both. I think Stag Industrial, if you're in the US or even a Canadian looking for a really foundational REIT, I really like Stag. It pays a 4% current dividend yield, similar to Granite. Not nearly as best performance. I'm surprised that Granite was able to jump up so much year to date, because Stag isn't keeping up at the same pace. But on the 1 year from those October lows, up 32%, very in line with Granite. The warehousing sector, I don't know why it's been able to be so resilient. Taking a look at Stag's dividend history here, again, nothing crazy. So again, we want to pick it up on those deep discounts, but the growth is what I love, because this thing like Granite, gross profit, total revenues have been increasing fabulously. One REIT to always be paying attention to that's going to give us real clerical insight into what's going on in the realm of rentals, because rental prices have increased even though real estate is beginning to correct. I think that's what's going to cushion some of the apartment REITs. And this one, the history is amazing. The yield not all that great. Year to date right now up 15%. From the October lows, we're up about 25%. And taking a look at the dividend, pretty healthy increases consistently. It was paying about 0.9 cents monthly. Now we're at about 12 cents. So this one, it gives you kind of the best of both worlds. Some dividend increases, some growth, but again, not a huge dividend yield. And taking a look, this one has been proving to be pretty resilient from a total revenue basis. They're looking to see total revenue at an all-time high for 2022, gross profit at an all-time high. So I really would prefer, if you're younger, maybe to be paying attention to the warehousing, some of the apartment REITs here in Canada. But I'll pass the question off to you. I'm really excited to see the real estate earnings come up at the end of this month, just to see how the market is performing and just to see what these billionaire REIT managers think of the current market environment. But I'll pass the question off to you. Let me know what you think.